Okay, now we're ready for the cash flow statement. And if you remember that from your first accounting course, you remembered it was a little bit different. And that's because what we want to do is look at the true cash, and we want to know where that cash came from. But you have to remember that we do our financial statements with an accrual basis rather than as on a cash basis. So your cash flow statement is a reconciliation report between where the cash came from as compared to what the profit says. So profits are not equal to cash. And why is that? Well, some people will use accounts receivable or charge their purchase from you and not pay for that for maybe 3 months. So there's no cash involved in that yet. So that's what your cash flow brings back into focus, is what was the true flow of the cash through the company. Just not the profit, but the cash. So here we go. And this just kind of explains the accrual base accounting, which says we record our revenues when we've earned them, and expenses also when they've incurred, rather than when the cash is paid or received, which really puts a kink in this cash flow. So we have to recreate that. Also, we have another issue with our long-term or fixed assets. We don't expense them out immediately. We pay for them with cash, or we borrow money to buy them, but we don't expense them right away. And what we do is we use depreciation each period. Well, depreciation as an expense does not incur any cash. It is just a written write-off, okay? So that has to be taken into consideration for a cash flow statement. So that makes this cash flow statement do this. So this is how we measure a firm's cash flow. First of all, you look for cash from operations, which means things that happen within the normal operations. How did the cash flow through there? We look for cash flows from investment opportunities, and we look for cash flows for financing activities. The investment opportunities are talking about resources we buy for the firms, such as equipment, investments, long-term investments that we place some of the funds in. Financing looks at bonds or repurchasing our preferred stock or cash dividend payments. Those are financing activities. And then that equals the net change in cash. So that's kind of the flow that we're looking for. And we do the conversion, okay, from accrual to cash in 2 steps. We back out the depreciation. There's no cash involved in that, remember, and add it back to the income statement. And then we look at current liabilities and assets and look at the change in their amounts from one period to the next period. So an example would be an increase in accounts receivable. And if an accounts receivable increased, we would have to subtract that from net income, because that increase, it does not involve cash, but it's in the net income, and we're trying to reconcile to the cash change between periods. So that would have to be subtracted out. Cash payments for inventory, which is an increase in inventory. We increased inventory, we would have to subtract that out of the net income, as we would have to decrease the money with an increase of accounts payable. So those two are kind of matched together. And there's some really 4 very good things in the textbook on page, my goodness, if I can find it very quickly as we're talking here, for cash flow that helps you kind of wrap around this, because it can be very, very confusing when you're thinking about it. It's like, why are you subtracting and adding and doing all of these things? And if you look on page 69 in the book, it has 4 very good reminders of what and why you do. And it also gives you when you add and subtract things back in. So make sure you really look at that page very closely. And this is just a schematic. We take net income, we add depreciation, and that equals profit before depreciation. And then we subtract increases in accounts receivable, or we add decreases in accounts receivable. We subtract cash payments for inventory if it's increased, and that equals cash flow from operations. Now remember, you have to add to that investment activities, which are changes in fixed assets, up or down, and financing activities, which are going to involve money, borrowing money, paying off short-term notes, increasing long-term debt. Any place where you've got an increase or decrease of cash has to be added here. Dividends would have to be removed. So that kind of gives you, and it's wonderful when this all maps out and it matches the change in from the beginning to the ending cash. It just gives you cold chills. So that's cash flow. Let's move on and look at income tax. So income tax, many decisions have been made about what to do with a company depending on how it affects their income tax. In fact, we have an activity of that for this week, which we'll talk about in a bit. So first you have gross income, and that's everything from what you've done less your production. Okay, so, and then you have to look at taxable income, and that's gross income less tax deductible expenses, plus interest income if you've received any, and any dividend income you may have received from your investments. So what are tax deductible expenses? Well, those are your operating expenses and your interest expense. Dividends paid are not tax deductible. So that is never included in the income that's going to be taxed. So let's kind of look at this. So we've got a typical income statement. We have all of the typical suspects in it. Here's our operating expenses. Here's our operating income right here. Then we take out our interest expense, which is just the way the setup is, and that gives us taxable income. So if we come down now, and here is the corporate tax rate for this particular company, and this is called marginal because you're looking at areas of where this tax is going to flow, and you'll see that was over 16 million, so it's going to be at a 35% rate, and it says 3% on income between 15 million and 18,333. That's going to be in addition to this. So this is a marginal tax rate. And finally, we come down to here is Hewlett-Packard's 2006, 7, and 8 income statements showing taxes provision at the very bottom here. So that's all figured, and actually that's the way the income statement is set up. It flows down through there, as you can see. Here's our operations. Here's our operating expenses. Here's our operating income. Here's our financing here, and that gives us the taxable income. And that concludes most of the overview of Chapter 3. I shall see you when we go over the assignments. Okay? Thank you.